about our wealth strategies. And today we have the final part, the third part of the startup funding rounds. So, we've been through part one, part two, and today it's part three. And just a quick recap about what we have seen. Just remember that when you look at a company, this is the curve of a successful company, But the important thing here is that you have the revenue and you have the timeline. And it just takes time until the revenue starts kicking in. Okay, it takes time. So you sometimes it can be this can be 1 year or 6 months or 3 years or 5 years or 10 years and so on. But it just takes time. It depends on the company, it depends on the team, it depends on the market, depends on the circumstances, depends on lots of factors. But it just takes time for a company, sometimes very quick, other times it just takes longer. But just keep in mind that it's not an immediate process. So what we have seen is that there are a number of funding rounds for a company, and you start with the bootstrapping, where you just do any way you can. You start, and then we just saw a presentation from Adaption Lab, and they're basically bootstrapping it. It's just the two founders, and they're doing whatever they can with the means they have. Then you have the angel, which is usually family and friends, and they invest or lend money to the founders at about up to about 50,000 euros or pounds or dollars. Then you go into the pre-seed, which is again the founders that are, they're committed. Maybe they mortgage their house, maybe they sell their car, but they're in, and they go for about 150,000. Okay, but they want to get it off the ground. They would just want to go for it. And then you have the seed round, which is this moment when you have companies are starting to have a minimum viable product, an MVP. They're starting to have some clients, to have some traction. Now it's a time to really boost it, to get it off the ground, really. Okay. Then you have the venture capital and the private equity, which are at higher levels. And then you have the other steps, which we're going to see today. The series, which are A, B, C, D, E, etc., and the IPO. So let's start with the series. You have the different series. You can start. Usually when we look back, a series is or these companies that are growth companies, they go and they do one series per year approximately. So the longer they and usually then they go and then either they're sold to a third party, or when they are very big, and you can think something like Facebook, Airbnb, Uber, and so on, they go for an IPO. Okay, and I'm going to talk about the IPOs in just a moment, but just a series. So they're funding. It's different times. Investors are coming in at different valuations at different moments in the life of the company, and of course some of them have also preferential shares, and usually investors with Series A, they get paid before investors from Series B, and so on. Okay, so Series A is investments from, let's say, anywhere between 2 million and 10 million, and it's the companies already have a growing revenue. They have a proven track record with clients. The clients are growing. That there is traction around it, and this funding round is basically to boost the sales, to increase the revenue by 4 or 5 times, or in the next 18 months or so. Okay, so that's the Series A. Then you can go for a Series B, which is now, it's for bigger companies, anywhere from 10 million to 30 million. Now you really want to fast track the company, want to take it to the next level, and the business model works. It's scalable. So now it's just a matter of money to pump those sales and get it going. All right. And then you have the Series C and beyond, basically. Okay, and that's anywhere from 15 million and upwards. There's basically no limit. Okay, and then companies are being funded for because they want to prepare the company for an IPO, for a buyout, for acquisitions. You know, they sometimes they go out and they buy some competitors and so on. So this is the idea. This is where they go. You know, they go and get money and they start, you know, growing. To grow fast is very expensive, so they need a lot of money. So they keep on going and getting funds and different series and so on. And sometimes, you know, it just takes, they can go series E, F, G, H, you know, it just keeps on going. All right. So just know that this is how it goes. From series C, then it's above 15 million, and it's really to scale up the company, to prepare it for really the next step. Then you have the IPOs. Now, the IPO can be an exit event for the founders, but it's also a funding round for the company, because the question is, how much money have you raised on the IPO? Okay, that is the question. Some companies have raised massive amounts, billions of euros and dollars. You know, some successful companies, like if you take Facebook, Alibaba, and Uber, and so many others. Very exciting to see what's going to happen with Airbnb, who just recently filed for their IPO. So very interesting to follow and see what's going to happen. So this will be, of course, an IPO is an opportunity for the founders and the early investors to cash out, at least partially or fully, depends. But it's also an opportunity for the company itself to be able to raise money. And once a company is listed on a stock exchange, then there are many mechanisms, many ways to raise money. So you have access to a different type of investors. You have all these institutional investors that have massive amounts of money to invest, but they are limited in the type of investments they can make. But they can't invest in private companies, but they can invest in listed companies. So the IPO stands for Initial Public Offering, and it's the first time shares in a private company are listed in a public market, in a stock exchange, and freely accessible. Okay, I think we had a small cut. We're back. So as I was saying, it's frequently when a company is listed, then it has access to a much wider pool of investors, that very, very rich investors, often institutional investors, that cannot invest in private companies, but they can invest in listed companies. So that's one way to do it. You get the company funded, and that's it. I mean, this is the top of the line. And of course, you can start in a minor exchange and then go up to a higher exchange, and higher, you know, being the London Stock Exchange, the main markets, the New York Stock Exchange, the Nasdaq. I mean, these are some of the most important markets. All right. Okay, good. So now you know all about funding rounds and in startup companies. So when you have all these three parts, then you know it all. Okay, that's what I wanted to share with you. Thank you very much.